Most traders don't fail because they don't know how to trade. They fail because they trade too big, too fast, and too emotionally. And the crazy part is this: the traders who make the most money over time usually look like they're doing almost nothing. Small position sizes, boring trades, slow growth, no screenshots, no flexing. While everyone else is chasing big wins, these traders are quietly stacking consistency. If trading big really worked, most traders would be rich by now. But they're not, and there's a reason for that. Today I want to show you why trading small is actually more profitable than trading big, why your brain performs better with less risk, and why the traders who survive long enough to win all learn this lesson the hard way. Let me start with something uncomfortable but true. Your account balance does not care how confident you feel. The market does not reward bravery. It rewards survival. Every trade you place is not just about profit. It's about whether you stay in the game long enough to let probability work. Trading big feels powerful. It feels serious. It feels like you're finally taking it seriously. But in reality, trading big usually means you're taking shortcuts. You're trying to compress time. You want results now. And markets punish impatience brutally. When you trade small, something important changes in your brain. Your nervous system stays calm. Your decision-making improves. You follow rules more closely. You exit when you're supposed to. You don't stare at every tick like it's life or death. This isn't opinion, it's biology. When risk is high, your brain shifts from logical thinking to survival mode. Stress hormones spike. You stop thinking in probabilities and start thinking in fear and hope. Fear makes you exit winners early. Hope makes you hold losers too long. Trading big activates the exact mental state that destroys performance. Here's a simple truth most traders don't want to hear. A great trading strategy executed with small size will outperform an average strategy executed with big size. Execution beats ideas every single time. Most people already have enough edge to be profitable. They just never allow it to play out because they sabotage it with oversized risk. Think about casinos for a moment. Casinos don't win because they bet big. They win because they bet small, consistently over thousands of repetitions. The house edge is tiny, sometimes less than 1%, but they never increase bet size emotionally. They never chase losses. They never panic. They survive long enough for math to work. Retail traders do the opposite. They try to turn a small edge into a big outcome by increasing size, and in doing so, they destroy the edge. When you trade big, every loss feels personal. It feels like failure. So you react. You revenge trade. You adjust stops emotionally. You skip rules. You trade setups you normally wouldn't. Not because you're stupid, but because your brain is overloaded. Trading small removes that pressure. Losses feel manageable. You accept them. You move on. And that emotional stability is what creates long-term profitability. There's also a math problem most traders ignore. Drawdowns grow exponentially with risk. Losing 10% is easy to recover from. Losing 50% is a nightmare. Lose 70% and you're basically trading from a psychological graveyard. Trading big increases the chance of large drawdowns. Large drawdowns don't just hurt your account, they permanently damage your confidence. Even if you recover financially, most traders never recover mentally. They start hesitating, doubting, second-guessing. Small size protects not just your capital, but your belief system. Another thing nobody talks about enough is learning speed. When you trade small, you can afford to be wrong. You can experiment. You can gather data. You can refine your process. When you trade big, every mistake is expensive, so instead of learning, you defend your ego. You blame the market. You blame news. You blame manipulation. Trading small keeps you honest. It turns trading into a skill instead of a gamble. Professional traders understand this deeply. Most of them started with ridiculously small size compared to what they could trade. They scaled only after consistency was proven. Not after one good month. Not after one lucky streak. After hundreds of trades. They focused on process first, profits second. Retail traders usually do the opposite. They increase size after a few wins, then wonder why everything falls apart. There's also the illusion of efficiency. Trading big feels efficient because you think you're making faster money. But faster money often means faster mistakes. Slow growth compounds. Fast growth explodes or collapses. There is no middle ground. The traders who last are the ones who accept boredom, routine, and patience. Trading small forces you into that mindset. Let me tell you something important. The market doesn't care how much you need money. It doesn't care about your goals, your bills, or your timeline. Trading big often comes from financial pressure. You want trading to solve problems quickly. But pressure and performance do not mix. Trading small separates your emotional needs from your trading decisions, and that separation is critical. Another hidden benefit of trading small is consistency. When size is small, you can trade the same way every day. Same risk, same rules, same behavior. That consistency creates reliable data. Reliable data creates confidence. Confidence creates discipline. Discipline creates profits. Trading big destroys that chain at the very first link. A lot of traders say, "I'll trade small once my account grows." That's backwards. Your account grows because you traded small, not the other way around. Size is not a reward. It's a responsibility, and responsibility comes after proof, not before. There's also a psychological trap with big trading that nobody warns you about. When you trade big and win, you don't feel proud. You feel relieved. Relief is not a healthy emotion in trading. It means you were risking too much. When you trade small and win, you feel neutral. Calm. Professional. That emotional neutrality is exactly where good decisions come from. Trading small also protects you from overconfidence. Big wins inflate ego. Ego leads to rule breaking. Small wins keep you grounded. They remind you that trading is a long game, not a performance. If you study traders who blew up accounts, a pattern appears. They didn't blow up because they were always wrong. They blew up because they were occasionally reckless. One oversized trade. One emotional decision. One "this will work" moment. Trading small removes the possibility of catastrophic error. You can be wrong many times and still survive. Survival is underrated, but it's everything. There's also freedom in trading small. You're not glued to the screen. You're not emotionally hostage to price movement. You can live your life. Ironically, that distance often improves performance. You're not forcing trades. You're not overmanaging. You're letting the system work. By 2026, markets are faster, noisier, and more crowded than ever. Information is everywhere. Edges are thinner. That makes discipline more important than ever. In an environment like this, the traders who win are not the loudest or the boldest. They're the most controlled. Small size is control. If trading big really created wealth, social media traders would be the richest people alive. But most of them disappear quietly. The ones who stay don't talk much. They don't need to. Their accounts speak over time, not in screenshots. Here's the real shift you need to make. Stop asking how much you can make on one trade. Start asking how long you can stay consistent. Trading is not about maximum profit. It's about minimum damage. Profits come as a side effect of survival. When you trade small, you stop trying to be right. You start trying to be consistent. That single shift changes everything. You stop chasing. You stop forcing. You stop proving. And that's when trading finally starts working. Most traders don't fail because the market is hard. They fail because they make it harder than it needs to be. Trading small feels slow. It feels unimpressive. But it's the fastest path to becoming profitable because it allows your edge to exist without interference. If you want to be around next year and the year after that and still trading with confidence, trade small. If you want excitement, trade big. But excitement has a short lifespan in markets. The traders who win don't trade to feel something. They trade to execute something. And execution thrives in calm, not chaos. So if you're tired of emotional swings, blown accounts, and feeling stuck, Don't change your strategy first. Change your size. Trade small enough that losing doesn't scare you. Trade small enough that winning doesn't excite you. That emotional balance is not boring. It's powerful. Because in trading, the goal isn't to look successful. It's to still be here when success finally arrives.